This book is not just about money. It is about a man who changed the way the world thinks about money, business, and life. Warren Buffett, often called the Oracle of Omaha, is more than an investor. He is a teacher, a philosopher of finance, and a living example of how discipline and patience can create extraordinary results. Carol J. Loomis, who worked at Fortune magazine for decades and was also a close friend of Buffett, has gathered here a lifetime of stories. Articles, interviews, and reflections written between 1966 and 2012 show how Buffett's ideas grew and influenced generations. Through these pages, we see the journey of a young man from Omaha who became one of the richest people on earth. But we also see something deeper, a man who never stopped being humble, humorous, and honest. The title of this book, Tap Dancing to Work, comes from Buffett himself. He often says that he loves his work so much that every day he feels like he is tap dancing to the office. It captures the joy of finding work that feels like play, and the energy that comes from doing what you love. This introduction is the doorway. From here we step into the very first portrait painted of Buffett for the wider world. A story written in Fortune magazine that showed readers a quiet genius from Nebraska. That story became the foundation of how the world would come to know him. And so, we begin. Chapter 1. The Introduction to Warren Buffett. Warren Buffett was born in 1930 in Omaha, Nebraska. From a very young age, he showed an unusual interest in numbers and money. He was not a child who just played with toys. He collected stamps, sold chewing gum, and delivered newspapers. He learned early that money is not just for spending, but for thinking, calculating, and investing. By the time he was 11, he had already bought his first stock. He was fascinated by the idea that a company's value could grow over time, and that careful decisions could multiply money quietly and steadily. This curiosity would become the foundation of his investing philosophy. Buffett's intelligence was evident, but so was his humility. He studied hard and absorbed lessons from his teachers and books. One book had a lasting impact: The Intelligent Investor by Benjamin Graham. Graham taught the principles of value investing. He explained that the market is often irrational and that careful analysis can uncover hidden opportunities. Buffett embraced this idea, but he would later adapt it to his own style. In his early career, Buffett tried many small ventures. He sold soda, bought pinball machines, and even tried selling golf balls door to door. These experiences taught him the value of hard work, persistence, and practical judgment. He learned that money comes not just from luck, but from patience, knowledge, and effort. After finishing college at the University of Nebraska, Buffett moved to New York to study under Benjamin Graham at Columbia Business School. Graham became not just a teacher, but a mentor who shaped Buffett's approach to investing. He showed him how to look at numbers critically, to understand the real worth of a business, and to avoid being swept away by market emotions. Buffett often says that Graham gave him both a map and a compass for life in business. By the mid-1950s, Buffett had returned to Omaha and started his own investment partnerships. These partnerships allowed him to pool money from friends and family to invest in stocks and small businesses. He was careful, disciplined, and methodical. His partners trusted him because he was honest, transparent, and never promised what he could not deliver. In just a few years, Buffett's investments began to show remarkable returns. What set Buffett apart was his combination of skill and temperament. He was not a gambler, but a patient observer. He studied businesses, waited for the right opportunities, and avoided emotional decisions. He believed in buying companies that were understandable, well-managed, and undervalued. His philosophy was simple but powerful. Know what you own, buy at a fair price, and hold for the long term. This first chapter also introduces the public side of Buffett. In 1966, Fortune magazine published its first story about him. It was a quiet piece, yet it captured the attention of readers. Here was a man who combined intellect with common sense, ambition with humility, and business acumen with personal integrity. The story described a rising star in finance, a man who seemed ordinary in appearance, but extraordinary in results. Readers learned that Buffett did not chase trends or follow market fads. He did not speculate on hot tips or gamble on quick gains. Instead, he applied a consistent, rational approach that respected both numbers and people. The article highlighted his growing influence and the beginnings of a reputation that would eventually span the globe. As we close this chapter, we see Buffett as both a thinker and a doer. He is a man shaped by early experiences, disciplined learning, and a careful, patient approach to investing. But he is also a man whose ideas were just beginning to reach the world beyond Omaha. The next chapter takes us deeper into that first fortune story, exploring how Buffett's early successes began to attract attention and set the stage for his extraordinary career. Chapter 2: The First Fortune Story on Buffett. In 1966, Fortune magazine published a story that would introduce Warren Buffett to a national audience. It was the first time many people outside Omaha had heard of him. The article portrayed Buffett not as a flamboyant Wall Street tycoon, but as a thoughtful, disciplined investor quietly building extraordinary success. At that time, Buffett managed several investment partnerships. He was already showing remarkable results, consistently outperforming the market. The magazine highlighted his unusual approach. He did not chase hot stocks or follow popular trends. Instead, he looked for undervalued companies with strong fundamentals and competent management. This method, rooted in the lessons of Benjamin Graham, was simple in theory, but required great patience and judgment. The story also emphasized Buffett's personality. He was approachable, humble, and surprisingly ordinary in appearance. He wore a simple suit, drove a modest car, and avoided the flashy lifestyle often associated with success. This contrasted sharply with the image of the typical high-profile investor, making him relatable to ordinary readers. Buffett's charm lay not in wealth, but in his integrity, clarity of thought, and love for what he did. Fortune's article explored how Buffett made his decisions. He focused on companies he could understand, avoiding businesses that were too complicated or speculative. He calculated intrinsic value, the real worth of a business based on its assets, earnings, and long-term prospects. Then he waited patiently for the market to offer a price below that value. If the price was fair or too high, he did nothing. If it was attractive, he invested decisively. Buffett's early partnerships were also discussed in the article. He pooled money from family and friends and ran the funds with complete transparency. Every partner knew the rules, the fees, and the risks. This honesty earned him trust and reinforced his reputation as a principled investor. His approach was not just about numbers, but about relationships, ethics, and long-term thinking. The magazine noted Buffett's discipline and temperament. He avoided the frenzy and noise of the stock market. He never let emotions dictate his decisions. This calm and rational mindset would become a hallmark of his career, enabling him to navigate crises, bubbles, and market swings with confidence. The article also hinted at Buffett's emerging philosophy beyond investing. He valued simplicity, patience, and continuous learning. He read constantly, studied businesses carefully, and sought advice from mentors like Benjamin Graham. This lifelong habit of learning set him apart from other investors and prepared him for the challenges of building Berkshire Hathaway. Readers were introduced to Buffett's first major investments. Small companies, overlooked stocks, and sometimes struggling businesses became opportunities under his careful analysis. One example was his early purchase of a textile company that later evolved into the holding company Berkshire Hathaway. Though the textile business itself struggled, Buffett's disciplined strategy allowed him to use it as a platform for future acquisitions. Fortune's story captured the beginning of a journey. It was not only a portrait of wealth, but a lesson in thoughtful investing, ethical business, and disciplined patience. The story made it clear that Buffett's success was not accidental. It was the result of careful planning, rational thinking, and unwavering principles. As this chapter closes, we see Warren Buffett stepping into public awareness. He is no longer just a young investor in Omaha. He is a model of integrity, intelligence, and long-term vision. The first fortune story planted the seeds of a legend that would grow over decades. Next, we explore how Buffett views business and investing, diving deeper into the ideas and principles that guide every decision he makes. Chapter 3: How Buffett Views Business and Investing. Warren Buffett's approach to investing is not just about numbers. It is about understanding businesses, human behavior, and the long-term value of ideas. He believes that money grows best when it is put into businesses you truly understand and trust. Buffett calls this investing in what you know. It is a principle that guides every decision he makes, from buying stocks to acquiring entire companies. Buffett separates speculation from true investing. Speculation is guessing what the market will do in the short term. Investing is analyzing a company's intrinsic value, patience, and discipline. Buffett does not buy a stock because it is popular or trending. He buys when the fundamentals of the business are strong and the price is attractive. A key concept in Buffett's thinking is intrinsic value. This is the real worth of a business, calculated by examining its assets, earnings, growth potential, and competitive advantages. He looks for companies whose stock price is below this intrinsic value. This margin of safety reduces risk and increases the chance of long-term success. Buffett often says that price is what you pay, but value is what you get. Buffett also values businesses with a durable competitive advantage, which he calls a moat. A moat protects a company from competitors, much like a castle is protected by a surrounding ditch. Companies with moats have strong brands, loyal customers, and cost advantages. Buffett prefers businesses that can sustain profits over decades rather than chasing short-term gains. Management is another crucial factor for Buffett. He invests in companies run by honest, competent, and capable people. He does not try to control day-to-day operations. Instead, he looks for leaders who share his values and can run the business effectively. Buffett believes that good managers will make decisions that create long-term value for shareholders. Buffett's philosophy also emphasizes patience. He is willing to wait for years until the right opportunity comes. Unlike most investors, he does not feel pressure to act every day or follow market noise. This discipline allows him to buy great businesses at fair prices and hold them indefinitely. He has often said that his favorite holding period is forever. Another principle Buffett follows is simplicity. He avoids complicated businesses and financial products he does not understand. He prefers transparent companies with predictable earnings and clear operations. This principle has helped him avoid many speculative bubbles and risky ventures that others have fallen into. Buffett's view of investing is also deeply connected to ethics. He believes in honesty, fairness, and integrity. A company's reputation and the trust it builds with customers and investors are as important as profits. For Buffett, making money without principle is not worth it. Buffett also distinguishes between price volatility and risk. He teaches that short-term market swings are not true risk. True risk comes from paying too much for a business or losing sight of its fundamental value. By focusing on intrinsic value and patience, he reduces risk while maximizing potential reward. Through these principles, Buffett has built a career of extraordinary returns and a reputation as one of the world's greatest investors. He combines rational analysis with human insight, disciplined strategy with patience, and financial skill with ethical responsibility. His approach shows that investing is not just about chasing numbers, but about understanding people, businesses, and the long game. As we finish this chapter, we are ready to explore the partnership that shaped Buffett's thinking. Next, we will look at Buffett and Charlie Munger, the man who became his lifelong partner and helped refine his philosophy on investing and business. Chapter 4: Buffett and Charlie Munger. Warren Buffett often says that no great investor succeeds entirely alone. For him, that person was Charlie Munger. Munger became Buffett's business partner, sounding board, and intellectual guide. Their partnership transformed the way Buffett viewed investing, acquisitions, and business strategy. Charlie Munger was different from Buffett in temperament and style. Where Buffett was patient and cautious, Munger was bold and contrarian. Munger challenged Buffett to think beyond traditional value investing. He encouraged him to consider not just price and intrinsic value, but the quality of the business and its long-term prospects. Together, They developed a philosophy that combined Buffett's discipline with Munger's broader perspective. Munger introduced the idea of quality investing. Buffett had long focused on buying undervalued companies at a discount. Munger helped him see that buying a truly exceptional business, even at a fair price, could generate far greater returns over time. This shift changed the course of Buffett's career and reshaped Berkshire Hathaway. It was no longer enough to find bargains. The business itself had to be strong, durable, and well managed. The partnership also emphasized rational thinking and mental models. Munger is famous for drawing on multiple disciplines, from psychology to economics, to improve decision-making. Buffett adopted this approach, learning to avoid common errors, biases, and mistakes that often trap investors. Together, they built a framework that prioritized long-term thinking, simplicity, and ethical behavior. Their collaboration extended beyond investment strategy. Munger influenced how Buffett evaluated acquisitions. They became highly selective, seeking businesses with sustainable competitive advantages and capable managers. They avoided companies that required constant intervention or relied on short-term market movements. This selectivity became a defining trait of Berkshire Hathaway's growth. Buffett and Munger also share a deep sense of humor and humility. They are not driven by ego or flashy wealth. They enjoy reading, learning, and discussing ideas. Their friendship allows for open debate, respectful disagreement, and the sharpening of ideas over time. This relationship has been as important to Berkshire Hathaway's success as the investments themselves. The book shows that their partnership created a culture of discipline, rationality, and patience. It also allowed Berkshire to take advantage of opportunities others overlooked. For example, Munger encouraged Buffett to invest in Coca-Cola, a company with a powerful brand and consistent profits. This investment became one of Berkshire Hathaway's most successful holdings. Buffett often says that good partners multiply success. Charlie Munger did exactly that. He pushed Buffett to think bigger, see farther, and act with confidence when opportunities arose. The synergy of their ideas, temperaments, and principles created a foundation for decades of exceptional results. As we close this chapter, we understand that investing is not just a personal skill, but a collaborative endeavor. Buffett's partnership with Munger illustrates how complementary thinking, shared values, and trust can amplify success. Their lessons go beyond finance. They teach patience, rationality, ethics, and the importance of choosing the right people to work with. Next, we will explore the growth of Berkshire Hathaway, the company that became the ultimate expression of Buffett and Munger's vision and strategy. Chapter 5. The growth of Berkshire Hathaway. Berkshire Hathaway did not start as the investment powerhouse we know today. Originally, it was a struggling textile mill in New England. Buffett acquired it in the early 1960s because its stock was undervalued. At first, it seemed like a modest investment, but Buffett had a vision that went far beyond the textile business. Buffett quickly realized that the textile operations alone would not create extraordinary returns. Instead, he saw Berkshire as a platform for acquiring other businesses. He used the company's cash flow and reputation to invest in insurance, finance, and other profitable industries. This strategy allowed Berkshire to grow steadily while maintaining discipline and avoiding unnecessary risk. Insurance became the key to Berkshire's expansion. Buffett purchased National Indemnity and other insurance companies, gaining access to large amounts of cash called float. Float is money that belongs to policyholders but can be invested before claims are paid. This provided Buffett with capital to invest without borrowing heavily. It was a brilliant strategy that became central to Berkshire's long-term success. Buffett also applied lessons from Charlie Munger. Together, they focused on acquiring businesses with strong competitive advantages, ethical management, and consistent earnings. Instead of micromanaging, they let managers run the companies independently. This approach encouraged loyalty, efficiency, and accountability. Berkshire became known as a company that trusted its managers and rewarded long-term thinking. Over the decades, Berkshire's portfolio grew to include a wide range of businesses. Textiles gave way to insurance, utilities, consumer goods, and financial companies. Iconic holdings included See's Candies, Coca-Cola, and Geico. Each acquisition followed the same principle: buy a great business at a fair price, led by competent managers, and hold it for the long term. The book emphasizes that Berkshire's growth was never about chasing trends or making risky bets. Buffett and Munger avoided speculative markets, technological fads, and short-term excitement. They invested in what they understood, calculated intrinsic value, and waited patiently for opportunities to appear. This strategy allowed Berkshire to grow consistently, even when other investors panicked or followed the crowd. Another factor in Berkshire's growth was discipline. Buffett resisted the temptation to diversify excessively or overpay for acquisitions. He focused on quality over quantity and preferred fewer, better investments rather than many mediocre ones. This patient and selective approach created compound growth over decades, making Berkshire one of the most valuable companies in the world. The culture of Berkshire Hathaway also reflected Buffett and Munger's values. Integrity, transparency, and long-term thinking became central principles. Employees and shareholders alike trusted that the company would act responsibly, even in challenging times. This reputation allowed Berkshire to attract talented managers, invest confidently, and maintain stability through market cycles. As we finish this chapter, we see Berkshire Hathaway as the living embodiment of Buffett and Munger's philosophy. It is a company built on disciplined investing, ethical management, and patient growth. From a struggling textile mill, it became a platform for extraordinary success, a testament to the power of vision, principles, and collaboration. Next, we will explore Buffett as a teacher of finance, and how he shared these lessons through letters, interviews, and public commentary to educate investors around the world. Chapter 6: Buffett as a teacher of finance. Warren Buffett is not just an investor, he is also a teacher. He believes that knowledge is valuable only when it is shared. Over decades, Buffett has educated investors, business leaders, and the general public through letters, interviews, and speeches. His approach is simple, clear, and often infused with humor. He avoids jargon, complicated formulas, and unnecessary complexity. Instead, he explains concepts in ways that anyone can understand. Buffett's letters to Berkshire Hathaway shareholders are legendary. Each year, he writes a letter that reviews the company's performance, explains investment decisions, and shares lessons learned. These letters are more than reports. They are textbooks on investing, ethics, and business strategy. He often candidly discusses mistakes, showing that even the most successful investor is not immune to error. This transparency builds trust and provides insight into his thought process. One of Buffett's key teaching points is the importance of long-term thinking. He contrasts investing with speculation. Speculators focus on short-term price movements and market trends. Investors, Buffett says, focus on the intrinsic value of businesses and hold them for the long term. By doing so, they benefit from the power of compounding and reduce the risk of emotional decision-making. Buffett also emphasizes understanding what you own. He teaches that investing in businesses you do not understand is dangerous. Knowledge, careful analysis, and patience are the foundation of successful investing. This lesson is illustrated through examples of companies he has bought, held, or avoided, highlighting the reasoning behind each decision. Ethics and integrity are central to Buffett's teaching. He believes that reputation is a company's most valuable asset. A business that treats its employees, customers, and shareholders well is more likely to succeed over the long term. He also stresses honesty in communication, as seen in his transparent letters and public statements. Buffett's teaching extends beyond finance. He shares wisdom on life, decision-making, and human behavior. He often points out that psychology plays a key role in investing. Emotions such as fear and greed can lead to mistakes. By understanding human behavior, investors can make more rational and disciplined decisions. Another lesson Buffett teaches is the importance of continuous learning. Even after decades of success, he reads thousands of pages every day. He studies businesses, industries, and market trends, constantly updating his knowledge. This habit of lifelong learning reinforces his ability to adapt, innovate, and make sound decisions over time. Buffett also uses humor and storytelling to make his lessons memorable. He often quotes historical figures, uses simple analogies, and shares anecdotes to illustrate complex concepts. This style makes learning enjoyable and accessible, turning even technical financial principles into engaging narratives. By the end of this chapter, we see Buffett not only as a master investor, but also as a mentor. His teachings empower others to think critically, act ethically, and invest wisely. He demonstrates that success is not just about making money. It is about understanding business, mastering discipline, and sharing knowledge. Next, we will explore the partnership letters, where Buffett honed his skills, developed his principles, and shared them with his early investors, laying the foundation for Berkshire Hathaway's enduring philosophy. Chapter 7. The Partnership Letters. Before Berkshire Hathaway became the giant it is today, Warren Buffett ran investment partnerships. These partnerships were pools of capital from friends, family, and trusted associates. Buffett used these partnerships as a laboratory for his investment ideas and strategies. He carefully documented his reasoning, results, and lessons in letters to his partners. These letters are now considered priceless guides for investors, offering insight into his thinking during the early years. Buffett's letters emphasized transparency and honesty. He reported both successes and mistakes openly. If an investment did not perform as expected, he explained why and what he learned. This openness built trust and created a culture of accountability. Partners knew that Buffett was not trying to hide mistakes or exaggerate returns. They trusted his judgment because of his integrity, discipline, and consistent results. The letters reveal Buffett's evolving philosophy on investing. He began by following Benjamin Graham's principles of value investing. He sought undervalued stocks that had a margin of safety, meaning the price was lower than intrinsic value. Over time, influenced by Charlie Munger, he shifted toward buying high-quality businesses at fair prices. This evolution is clearly visible in the letters, showing how Buffett adapted and improved his approach. A central theme in the letters is patience. Buffett repeatedly stressed the importance of waiting for the right opportunity. He did not feel pressured to act every day or chase market trends. Instead, he carefully analyzed businesses, considered their long-term potential, and only invested when the odds were favorable. This discipline allowed him to generate exceptional returns while minimizing risk. The letters also highlight Buffett's views on risk and market behavior. He warned against speculation, emphasizing that short-term market fluctuations are not the same as real risk. Real risk comes from overpaying or investing in businesses that cannot sustain profits. By focusing on intrinsic value, Buffett showed that investors could make sound decisions even during volatile markets. Buffett's letters were also educational. He explained concepts such as compounding, margin of safety, and intrinsic value in clear, simple language. He used stories, analogies, and humor to make the lessons memorable. For example, he likened investing to a baseball game, where knowing the rules, studying the players, and waiting for the right pitch can make all the difference. Another important aspect of the letters is Buffett's focus on ethics. He believed that honesty, fairness, and integrity were essential to long-term success. He advised partners to invest responsibly and avoid shortcuts. He showed that trust and reputation are as valuable as capital. This ethical approach became a hallmark of his career and a foundation for Berkshire Hathaway's culture. The letters also give insight into Buffett's personality. He was disciplined but witty, serious but humble. He cared about his partners, their trust, and their long-term success. He demonstrated that investing is not just about money, but about relationships, principles, and thoughtful decision-making. By the end of these partnership letters, we see Buffett not only as a skilled investor, but also as a teacher and mentor. He refined his principles, tested his strategies, and documented lessons that would guide his career for decades. These letters laid the groundwork for Berkshire Hathaway's philosophy, showing the power of transparency, discipline, and long-term thinking. Next, we will explore How Buffett thinks about market valuation, diving deeper into his methods for determining when a business is a good investment and how he navigates market cycles. Chapter 8. How Buffett thinks about market valuation. Warren Buffett views the stock market differently than most investors. To him, the market is a tool, not a guide. He does not follow daily price movements or get distracted by short-term trends. Instead, he focuses on the underlying value of a business. Buffett asks one key question for every investment. What is this company really worth? This is where the concept of intrinsic value comes into play. Intrinsic value is the true worth of a business based on assets, earnings, growth potential, and long-term sustainability. Buffett studies financial statements, evaluates management quality, and considers competitive advantages. He calculates whether the stock price reflects this real value or if it is too high or unusually low. Buffett also emphasizes the margin of safety. Even if a company is strong, the market may overprice it. Buying at a discount to intrinsic value reduces risk and increases the probability of long-term gains. He often says that price is what you pay, and value is what you get. This simple idea has guided nearly every investment decision he has made. Market psychology is another critical factor in Buffett's valuation approach. He understands that emotions drive short-term prices. Fear and greed often create opportunities for disciplined investors. Buffett famously advises to be fearful when others are greedy, and greedy when others are fearful. By focusing on the fundamentals rather than hype, he avoids impulsive decisions and capitalizes on mispricing. Buffett also looks for businesses with durable competitive advantages. He calls these advantages moats, which protect companies from competitors. Strong brands, loyal customers, proprietary technology, and cost leadership create moats. A company with a moat can maintain profits over decades, even through economic cycles. This principle helps Buffett select companies that are not only undervalued, but also likely to grow steadily. Another aspect of valuation is management quality. Buffett evaluates whether leaders are honest, competent, and aligned with shareholders' interests. Even a great business can fail under poor leadership. He invests in companies where management is trustworthy, capable, and long-term oriented. Buffett also avoids complicated financial instruments. He prefers businesses with simple, predictable operations that he can understand. This clarity reduces risk and allows him to focus on long-term potential rather than short-term speculation. Complexity, he believes, often hides danger. His approach extends beyond individual stocks to the broader market. Buffett does not try to time the market or predict macroeconomic trends. He measures market valuation relative to the underlying value of businesses. If the market offers attractive prices, he buys. If prices are high, he waits patiently for better opportunities. Buffett's methods combine careful calculation with common sense. He reads, studies, and analyzes continuously, but also relies on practical judgment. He balances numbers with intuition, research with experience, and patience with decisive action. This approach allows him to identify value where others see risk or uncertainty. As this chapter closes, we see Buffett's valuation philosophy as a blend of discipline, patience, and rational thinking. He buys quality businesses at reasonable prices, considers management and moats, and navigates market emotions with clarity. Next, we will explore his philosophy on acquisitions, showing how Buffett applies these principles to expand Berkshire Hathaway and create lasting value. Chapter 9. His philosophy on acquisitions. Warren Buffett's approach to acquisitions is as disciplined and thoughtful as his investing. He does not rush into buying companies. Instead, he carefully evaluates each opportunity, focusing on long-term value rather than short-term gain. For Buffett, an acquisition is not just a transaction. It is a commitment to a business, its people, and its future. Buffett looks for businesses with predictable earnings and strong fundamentals. He prefers companies that are understandable, profitable, and have a durable competitive advantage, or a moat. These moats protect the business from competitors, ensuring it can sustain earnings over decades. He avoids businesses that rely on fads, speculation, or complex financial structures. If he cannot clearly see how the business makes money, he does not buy it. Management quality is crucial in acquisitions. Buffett does not seek to control every decision, but invests in leaders who are competent, honest, and aligned with shareholders. He values integrity above all, believing that trust in management is the foundation for long-term success. Acquisitions are not just about price, they are about people, culture, and sustainability. Price and intrinsic value remain central to Buffett's philosophy. He will pay a fair price for a great business, but avoids overpaying, even for an exceptional company. This discipline protects Berkshire Hathaway from financial risk and ensures that acquisitions generate long-term growth. Buffett often says it is better to wait for the right opportunity than to act impulsively. Another principle is patience. Buffett waits for the right conditions, the right company, and the right price. He does not succumb to market pressure, trends, or the expectations of others. This patience allows him to identify businesses that others overlook or undervalue. It is a strategy that has produced some of Berkshire Hathaway's most successful acquisitions. Buffett also applies a long-term perspective to acquisitions. He does not plan to sell businesses quickly for short-term profit. Instead, he views acquisitions as long-term holdings that generate steady cash flow and compound value over time. This mindset contrasts sharply with many corporate buyers who focus on quick gains or financial engineering. Acquisitions also reflect Buffett's ethical approach to business. He treats sellers and employees with respect and fairness. He avoids hostile takeovers or aggressive tactics that harm relationships or reputations. For Buffett, a good acquisition benefits everyone: the company, its employees, the community, and Berkshire Hathaway shareholders. Over time, this philosophy has allowed Buffett to build a diverse portfolio of high-quality companies. From See's Candies to Geco, Coca-Cola, to BNSF Railway, each acquisition follows the same principles: quality, management, moats, fair price, and long-term growth. Buffett's disciplined approach reduces risk and maximizes the probability of lasting success. By the end of this chapter, we see that Buffett's acquisition strategy is not about speed, speculation, or opportunism. It is about careful selection, ethical behavior, and long-term thinking. Every purchase is a deliberate decision grounded in analysis, integrity, and patience. Next, we will explore Buffett and the Washington Post, a landmark investment that showcases these principles in action and highlights how he combines analysis with insight to make transformational acquisitions. Chapter 10: Buffett and the Washington Post. One of Warren Buffett's most famous acquisitions was his investment in the Washington Post. This deal is a perfect example of how he applies his philosophy of disciplined, ethical, and long-term investing. Buffett first noticed the Washington Post because of its strong brand, consistent earnings, and loyal readership. It was a company with a durable competitive advantage, exactly the type of business he sought. In the early 1970s, the Washington Post stock was undervalued due to market skepticism and temporary challenges. Many investors overlooked it, focusing instead on speculative opportunities or fads. Buffett saw an opportunity. He carefully analyzed the company's finances, management, and market position. He realized that the underlying business was solid and that the stock price did not reflect its intrinsic value. Management quality played a critical role in Buffett's decision. He had great respect for Katharine Graham, the publisher, and the leadership team. Their integrity, competence, and long-term vision aligned perfectly with Buffett's principles. He believed that under their guidance, the company would continue to thrive for decades. Trust in management was as important as the numbers on the balance sheet. Buffett began purchasing shares of the Washington Post quietly but steadily. Over time, he accumulated a significant stake, becoming a key shareholder. His approach was methodical and patient. He did not try to dominate or control the company. Instead, he invested in the business, trusting its leadership to make smart decisions. This investment highlighted several of Buffett's core principles. First, the importance of intrinsic value. The stock price was lower than the real worth of the business. Second, the focus on moats. The Washington Post had a loyal readership, a strong reputation, and a dominant market position. Third, management quality. Capable and ethical leaders were in place to sustain growth. Finally, patience. Buffett waited for the right opportunity and trusted the long-term potential. Over the years, Buffett's stake in the Washington Post proved highly profitable. The company's value grew steadily, reflecting the strength of its business and leadership. Buffett's approach did not rely on speculation or market timing. It relied on understanding, analysis, and long-term thinking. It became a model for other investors seeking sustainable growth. The story of the Washington Post also illustrates Buffett's ethical approach to investing. He treated the company, its employees, and its shareholders with respect. He did not pursue aggressive control or hostile tactics. His goal was to support the business, create value, and align interests. This acquisition also enhanced Buffett's reputation. It showed that he could identify high-quality opportunities overlooked by the market. It demonstrated his patience, discipline, and ability to combine financial analysis with human insight. As this chapter closes, we see that Buffett's investment in the Washington Post was more than a financial decision. It was a textbook example of his philosophy in action. Buy quality businesses at reasonable prices, trust management, and hold for the long term. Next, we will explore how he deals with market crashes, revealing Buffett's calm and rational approach to economic turmoil and financial uncertainty. Chapter 11: How he deals with market crashes. Warren Buffett's approach to market crashes is one of the most admired aspects of his career. Unlike many investors who panic when markets fall, Buffett remains calm, rational, and focused on fundamentals. He views market downturns not as threats, but as opportunities to invest in high-quality businesses at attractive prices. This mindset separates him from those who react emotionally to fear and uncertainty. Buffett believes that the stock market is often driven by short-term sentiment, not true value. When prices drop due to panic, speculation, or temporary problems, the market can misprice even strong businesses. For a disciplined investor, this creates a chance to buy more of what is already proven to work. He famously advises to be greedy when others are fearful, and fearful when others are greedy. During crashes, Buffett does not try to predict timing or guess the bottom. Instead, he evaluates businesses based on intrinsic value, competitive advantage, and management quality. He invests only when he believes the price offers a significant margin of safety. This approach minimizes risk while maximizing potential long-term gains. Historical crashes provide vivid examples of Buffett's strategy in action. During the stock market crash of 1973 to 74, he maintained a steady approach. He avoided panicking, did not sell quality holdings, and waited for opportunities to acquire undervalued businesses. Similarly, in the 1987 crash and the tech bubble of the late 1990s, Buffett stayed focused on fundamentals. He resisted hype, ignored short-term volatility, and concentrated on companies with durable advantages. Buffett also stresses the importance of cash and liquidity during crises. Having cash on hand allows an investor to act decisively when opportunities arise. Berkshire Hathaway's cash reserves during market turmoil became a key advantage, enabling acquisitions and investments that others could not make. This principle reflects Buffett's long-term thinking and his readiness to take advantage of temporary disruptions. Behavioral discipline is central to his approach. Buffett recognizes that fear and greed are powerful forces that lead to mistakes. He trains himself and encourages others to detach emotionally from market swings. By focusing on logic, analysis, and intrinsic value, he avoids rash decisions that could harm long-term performance. Another lesson from crashes is humility. Buffett studies history and learns from past mistakes. He recognizes that markets will always experience volatility and that no one can predict every outcome. This humility keeps him grounded and allows him to act rationally even in chaotic conditions. Buffett also sees opportunity in adversity. Market crashes often provide chances to acquire excellent businesses at low prices. He has repeatedly turned downturns into long-term advantages by investing in companies with strong moats, ethical management, and sustainable earnings. Crises test investors, but they also separate disciplined, patient thinkers from those driven by emotion. By the end of this chapter, it is clear that Buffett's approach to market crashes is consistent with his broader philosophy: patience, discipline, focus on value, and ethical decision-making. He views downturns as temporary noise, not permanent damage, and acts with rationality rather than fear. Next, we will explore Buffett and corporate governance, examining how he uses his influence to shape responsible and effective management practices in the companies he invests in. Chapter 12: Buffett and Corporate Governance. Warren Buffett places great importance on corporate governance. He believes that how a company is governed is as important as its financial performance. Strong governance ensures that management acts in the best interests of shareholders, employees, and the long-term health of the business. Buffett's philosophy on governance is grounded in ethics, transparency, and accountability. Buffett often says that the best companies have leaders who are honest, capable, and aligned with shareholders' interests. He invests in businesses where executives make decisions based on long-term value rather than short-term personal gain. For him, integrity in leadership is non-negotiable. A company with great numbers but poor governance is a risky investment. He also emphasizes trust and autonomy. Buffett does not micromanage the companies he acquires. Instead, he selects competent managers and gives them freedom to run the business. This approach fosters accountability, loyalty, and innovation. Managers know they are trusted and can focus on creating sustainable growth. Another key principle is alignment of interests. Buffett prefers management teams whose incentives are tied to the long-term success of the company. This reduces conflicts and encourages decisions that benefit shareholders over time. He often avoids companies where executives prioritize short-term stock price or personal bonuses. Buffett also values transparency. Companies should provide clear, honest, and timely information to shareholders. He believes that shareholders deserve to know what is happening inside the business. This openness builds trust and allows investors to make informed decisions. Corporate governance, in Buffett's view, extends beyond compliance with rules and regulations. It is a culture of ethical behavior, prudent decision-making, and accountability. A well-governed company treats employees, customers, and investors with respect. It makes rational choices that ensure the long-term health of the business. Berkshire Hathaway itself reflects Buffett's governance philosophy. Its decentralized structure allows subsidiaries to operate independently. Managers are empowered to make decisions, but accountability is clear. Buffett and Munger provide guidance, oversight, and capital allocation, but do not interfere in day-to-day operations. This model has contributed to consistent performance and strong corporate culture. Buffett's influence extends beyond Berkshire. Through his investments and public commentary, he encourages other companies to adopt high standards of governance. He shows that ethical leadership, transparency, and alignment of interests are not just moral choices. They are also smart business decisions. Good governance reduces risk, enhances reputation, and creates long-term value. By the end of this chapter, it is clear that Buffett views governance as a central pillar of investing. Financial analysis alone is not enough. The quality of leadership, ethical standards, and transparency determine whether a company can sustain profits and survive challenges. Next, we will explore the role of taxes and Buffett's opinions, examining how he views taxation, policy, and their impact on investors and business strategy. Chapter 13: The Role of Taxes and Buffett's Opinions. Warren Buffett has long shared his views on taxes and their role in business and investing. He believes that taxation is not just a government issue. It affects corporate strategy, investment decisions, and the broader economy. Buffett's opinions combine practicality, ethics, and an understanding of long-term economic effects. Buffett advocates for fairness in taxation. He has repeatedly emphasized that wealthy individuals and corporations should pay their share. He believes that the tax system should be structured to encourage responsible behavior, long-term investment, and economic growth. Buffett has often pointed out the disparity between the tax rates paid by ordinary workers and the ultra-wealthy. He calls for reforms that ensure fairness and reduce loopholes that allow some to avoid paying proportionate taxes. Taxes also influence investment behavior. Buffett understands that high tax rates on capital gains, dividends, or corporate earnings can shape decisions. However, he emphasizes that smart investors consider taxes as part of planning, not as a reason to avoid investing responsibly. He believes in minimizing taxes legally through strategies like holding investments long-term, but opposes aggressive avoidance or evasion. Buffett's personal actions reflect his philosophy. He pays substantial taxes, encourages transparency, and supports policies that promote economic fairness. He famously challenged the idea that billionaires should pay lower tax rates than ordinary workers. His advocacy demonstrates that ethical considerations and practical business sense can coexist. Buffett also discusses the role of taxes in corporate strategy. Companies should structure operations to remain profitable, grow responsibly, and contribute fairly to society. He believes that businesses benefit when they operate within the law, act transparently, and align with the long-term interests of shareholders and communities. Avoiding ethical responsibility for the sake of lower taxes can damage reputation, reduce trust, and harm long-term prospects. Another key point Buffett makes is about the simplicity of tax planning. He advises investors to focus on clear, understandable strategies rather than complicated schemes. This mirrors his broader investing philosophy: clarity, simplicity, and long-term thinking. Complex arrangements may appear beneficial in the short term, but can create risk, confusion, and ethical dilemmas. Buffett also views taxes as part of the social contract. He acknowledges that taxes fund infrastructure, education, healthcare, and economic stability. Paying taxes responsibly contributes to a healthy society, which benefits businesses, communities, and future generations. He frames taxation not as a burden, but as a necessary part of sustaining the environment in which companies and investors operate. Finally, Buffett emphasizes the importance of transparency. Investors should understand how taxes affect their returns and plan accordingly. Companies should disclose their tax practices clearly, and policymakers should aim for fairness and consistency. Ethical, transparent, and responsible behavior around taxes is an extension of sound corporate governance and long-term thinking. By the end of this chapter, it is clear that taxes are not just numbers on a form. They are a reflection of ethics, fairness, and responsibility. Buffett combines practical strategy with moral clarity, showing that paying taxes is both a duty and a smart long-term approach. Next, we will explore Buffett's view on derivatives and risk, revealing his perspective on complex financial instruments, their dangers, and how to navigate modern markets responsibly. Chapter 14. Buffett's view on derivatives and risk. Warren Buffett has a cautious and clear perspective on derivatives and financial risk. He views derivatives as tools that can be dangerous if misused. In his letters and interviews, Buffett has often warned that complex financial instruments can create hidden risks for investors, banks, and the broader economy. He believes in simplicity, transparency, and understanding before committing capital. Derivatives are contracts whose value is derived from another asset, such as stocks, bonds, or commodities. While they can be used for hedging or risk management, they can also be speculative and highly leveraged. Buffett compares derivatives to weapons that can be misused, causing large losses for those who do not fully understand them. He famously called derivatives financial weapons of mass destruction because of the potential for catastrophic risk. Buffett's philosophy is grounded in understanding. He only invests in instruments he fully comprehends and avoids those that are opaque or overly complex. He values predictability and transparency. When an instrument cannot be understood clearly, it is likely to carry hidden dangers. This approach aligns with his broader investing principles. Avoid unnecessary risk, focus on fundamentals, and protect capital. Risk management is central to Buffett's approach. He distinguishes between market fluctuations, which are temporary, and true business risk, which threatens the permanent loss of capital. Derivatives often increase the latter by adding leverage, counterparty risk, and uncertainty. Buffett's caution is not fear. It is rational assessment of potential consequences. Buffett also emphasizes the importance of moral and ethical responsibility in dealing with derivatives. Speculative use of derivatives can harm companies, investors, and society. He argues that investors and executives must understand the broader impact of their actions and prioritize long-term stability over short-term gains. This ethical framework complements his financial prudence. Insurance and hedging are exceptions where derivatives can be used responsibly. Buffett recognizes that companies like Berkshire Hathaway can use derivatives to manage risk, reduce exposure, and stabilize operations. In these cases, he ensures that contracts are clear, obligations are manageable, and the use aligns with long-term strategy. This selective use shows his ability to balance risk with opportunity intelligently. Buffett also believes that education and awareness are key. Investors should understand the mechanics, risks, and potential consequences of derivatives before using them. Blindly following trends or engaging in speculative behavior is dangerous and often leads to severe financial losses. By applying his principles of simplicity, ethical responsibility, and long-term thinking, Buffett demonstrates that modern financial instruments can be approached with caution and intelligence. Derivatives are not inherently evil. They are tools, but they require careful handling, understanding, and respect for the risks involved. By the end of this chapter, it is clear that Buffett's view on derivatives reflects his broader philosophy. Avoid unnecessary complexity, prioritize safety, and focus on value and ethical responsibility. Next, we will explore Buffett. During the 1999 tech bubble, examining how he navigated speculative mania, avoided irrational investments, and stayed disciplined when markets were driven by hype. Chapter 15. Buffett. During the 1999 tech bubble. The late 1990s were defined by the dot-com boom. Technology stocks soared as investors rushed into internet companies with little regard for profits or fundamentals. Many people believed that the rules of investing had changed and that rapid growth alone justified enormous valuations. Buffett saw this frenzy as a classic example of speculation overriding sound judgment. Buffett famously avoided investing in most tech stocks during this period. He did not succumb to the hype, even as friends, media, and analysts pressured him to participate. Instead, he applied the same disciplined principles he had used for decades. Buy businesses you understand, evaluate intrinsic value, and focus on long-term fundamentals. Most tech companies of the time had unproven business models, little earnings, and no sustainable competitive advantage. For Buffett, these were high-risk bets, not investments. He consistently warned about the dangers of speculative bubbles. In shareholder letters, interviews, and speeches, he emphasized the importance of rational decision-making. He pointed out that chasing market trends can lead to permanent losses, especially when prices are disconnected from value. Buffett's approach was calm, rational, and patient. He recognized that the bubble was temporary and that long-term value would eventually prevail. Berkshire Hathaway's portfolio during the tech bubble reflected Buffett's prudence. He continued to invest in companies with predictable earnings, strong moats, and ethical management. Coca-Cola, See's Candies, and insurance businesses remained core holdings. These companies were not trendy, but they produced consistent cash flow and long-term growth. By avoiding speculative tech stocks, Buffett protected capital and preserved opportunities for future investments. Buffett also emphasized investor behavior during the bubble. He noted that emotional decisions, fear of missing out, and herd mentality often drive people to overpay. Investors who ignored fundamentals were setting themselves up for losses when the bubble inevitably burst. Buffett urged patience, critical thinking, and adherence to sound principles. The aftermath of the dot-com bubble validated Buffett's approach. Many high-flying tech companies failed completely or lost substantial value. Investors who followed hype suffered severe losses. Meanwhile, Berkshire Hathaway continued to grow steadily, benefiting from disciplined, long-term investing. Buffett's reputation as a rational, ethical, and patient investor was reinforced. Buffett's behavior during this period also illustrates the power of independent thinking. He did not follow the crowd or succumb to peer pressure. He relied on analysis, experience, and clear principles. This independence allowed him to act rationally when others were driven by fear or greed. Finally, the tech bubble period highlighted Buffett's central investing lesson: price matters, and understanding matters more. Buying an exciting company at an irrational price is not investing. It is speculation. Buffett demonstrated that sticking to fundamentals, exercising patience, and focusing on value provides resilience during periods of market mania. By the end of this chapter, we see that Buffett's approach to the 1999 tech bubble reflects his enduring philosophy: disciplined analysis, patience, rational decision-making, and ethical responsibility. Next, we will explore lessons from the dot-com era, extracting broader insights from the bubble and its collapse for investors seeking long-term success. Chapter 16: Lessons from the dot-com era. The dot-com era of the late 1990s was a period of exuberance, speculation, and rapid technological innovation. It created enormous wealth for some, but also severe losses for many. Warren Buffett's experience during this era provides valuable lessons for investors seeking long-term success. One key lesson is the importance of fundamentals. Buffett consistently emphasized that the value of a company lies in its earnings, assets, and competitive advantage. Investors who ignored these fundamentals and focused solely on hype or rapid growth often suffered losses when the bubble burst. Understanding the real worth of a business is more important than following market trends. Another lesson is patience. The dot-com era tempted many investors to chase quick gains. Buffett demonstrated that disciplined patience is far more rewarding than impulsive decisions. He waited for companies that met his criteria for value, management quality, and long-term sustainability. This patience allowed him to avoid speculative traps and protect capital. The era also highlighted the dangers of herd mentality. Investors often buy what others are buying without analyzing the underlying business. This behavior inflates prices and creates bubbles. Buffett's approach was independent thinking. He assessed each company on its own merits, regardless of market popularity. This independence is crucial for avoiding the pitfalls of speculation. Risk management is another critical lesson. Many dot-com companies were over-leveraged or had unsustainable business models. When the market turned, these weaknesses led to massive losses. Buffett focuses on minimizing permanent capital loss, emphasizing investments with predictable earnings, strong moats, and ethical management. Understanding risk is as important as identifying opportunity. The dot-com era also reinforced the value of ethics and integrity. Buffett avoids companies with opaque practices or misleading financial statements. Trustworthy management is essential, especially during periods of rapid change or market euphoria. Companies that cut corners or prioritized hype over substance often failed when the bubble collapsed. Buffett's experience teaches the power of simplicity. Many investors were seduced by complex technology, jargon, and projections. Buffett's success came from investing in businesses he could understand clearly. Simplicity, transparency, and clarity are more reliable than speculation and complexity. Another lesson is the enduring importance of long-term thinking. The dot-com boom was driven by short-term excitement, but long-term value always prevails. Companies with sustainable business models, ethical leadership, and real competitive advantages endure. Investors who focus on long-term fundamentals outperform those chasing momentary trends. Finally, the dot-com era reminds investors to balance caution with opportunity. Crashes and bubbles create chances for disciplined investors to acquire high-quality businesses at attractive prices. Buffett turned market mania into advantage by adhering to principles rather than following hype. This approach emphasizes resilience, rationality, and ethical decision-making. By the end of this chapter, it is clear that the lessons of the dot-com era are timeless. Fundamentals, patience, independent thinking, risk awareness, ethical behavior, simplicity, and long-term focus form the foundation of successful investing. Next, we will explore Buffett's take on the 2008 financial crisis, showing how he navigated extreme market stress with prudence, clarity, and opportunity. Chapter 17. Buffett's take on the 2008 financial crisis. The financial crisis of 2008 was one of the most severe economic events in modern history. Banks collapsed, markets plummeted, and investor confidence reached record lows. During this period of uncertainty, Warren Buffett's approach demonstrated the power of discipline, patience, and rational thinking. Buffett viewed the crisis as both a challenge and an opportunity. He recognized that fear and panic were driving irrational market behavior. Many investors were selling at fire sale prices, while others were speculating wildly. Buffett focused on fundamentals, assessing which companies were strong, resilient, and ethically managed. He avoided panic, concentrating on long-term value rather than short-term losses. One of Buffett's key principles during the crisis was liquidity. Berkshire Hathaway held substantial cash reserves, allowing Buffett to act decisively when opportunities arose. Unlike many companies that were over-leveraged, Berkshire had the capital to invest in distressed but fundamentally sound businesses. This ability to deploy capital strategically turned the crisis into a long-term advantage. Buffett also emphasized understanding risk. He avoided complex or highly leveraged investments that could lead to catastrophic losses. Instead, he sought opportunities where the risk was quantifiable and manageable. His mantra remained consistent: avoid permanent loss of capital, focus on businesses with strong moats, and trust capable management. During the crisis, Buffett made several landmark investments that reflected his philosophy. He invested in companies like Goldman Sachs and General Electric under favorable terms, providing liquidity to struggling firms while securing attractive returns for Berkshire Hathaway. These deals were carefully structured, transparent, and based on intrinsic value. They exemplified Buffett's ability to act decisively when others were paralyzed by fear. Buffett also provided guidance and reassurance to the broader market. He emphasized rational thinking, patience, and adherence to fundamentals. He warned against panic selling and speculative behavior, reminding investors that short-term volatility does not reflect long-term value. His calm, reasoned approach served as a model for others navigating the crisis. Another lesson from 2008 is the importance of ethics and trust. Buffett prioritized investments in companies with honest, competent management. He avoided firms engaged in reckless or deceptive practices, understanding that reputation and integrity are crucial during turbulent times. Trustworthy leadership reduces risk and increases the probability of recovery and long-term success. Buffett's approach during the financial crisis also highlighted opportunity and adversity. Market downturns create conditions to acquire high-quality businesses at discounted prices. His long-term perspective allowed him to act when others could not, turning crisis into advantage. This underscores a central theme in Buffett's investing philosophy. Disciplined patience, rational analysis, and ethical judgment consistently outperform panic and speculation. By the end of this chapter, it is evident that Buffett's response to the 2008 crisis combined financial prudence, ethical standards, and strategic insight. He navigated uncertainty, capitalized on opportunity, and reinforced the timeless principles of value investing. Next, we will explore his role in saving companies during the crisis, examining how Buffett helped stabilize key businesses and the broader economy through thoughtful interventions. Chapter 18. His role in saving companies during the crisis. During the 2008 financial crisis, Warren Buffett played a pivotal role in stabilizing key companies and restoring confidence in the economy. While many investors panicked, Buffett used his capital, expertise, and reputation to provide crucial support to firms in distress. His actions were guided by the same principles that had defined his career: discipline, ethical responsibility, and long-term thinking. One of Buffett's most notable interventions was his investment in Goldman Sachs. The investment provided the company with much-needed liquidity, while securing attractive terms for Berkshire Hathaway. Buffett structured the deal carefully, ensuring transparency, minimal risk, and alignment with long-term value creation. This was not a speculative gamble. It was a strategic, disciplined move to support a strong, well-managed company during extraordinary market stress. Buffett also invested in General Electric, another company facing severe financial challenges. By providing capital through well-structured agreements, he helped stabilize operations, reassure investors, and maintain confidence in the broader financial system. These actions demonstrated that strategic interventions can serve both the investor and the public interest when executed responsibly. His approach emphasized ethical responsibility. Buffett did not seek to exploit companies in distress. He aimed to help them survive and thrive while protecting shareholders' interests. He prioritized fairness, transparency, and long-term sustainability over short-term gain or opportunistic advantage. This ethical stance reinforced his reputation as an investor who combines financial acumen with moral clarity. Buffett's interventions also reflect the importance of reputation in business. Companies, employees, and investors trusted him because of his integrity, discipline, and track record. This trust allowed him to negotiate deals efficiently and make a meaningful impact during the crisis. His reputation became a form of capital, amplifying the effect of his financial support. Another lesson is the power of patience and timing. Buffett did not rush into every opportunity or respond to panic. He analyzed each situation carefully, identifying companies with strong fundamentals, capable management, and sustainable moats. By acting selectively, he maximized the impact of his interventions while minimizing risk. Buffett's role during the crisis also highlights his focus on the long-term perspective. He viewed temporary market disruptions as opportunities to strengthen relationships, acquire value, and support economic stability. Rather than chasing short-term profit, he prioritized lasting value and resilience. This approach benefited both Berkshire Hathaway and the companies he invested in. Finally, Buffett's actions demonstrate how disciplined investors can act as stabilizers during periods of systemic stress. By combining capital, analysis, patience, and ethics, he helped prevent further panic, supported business continuity, and positioned Berkshire Hathaway for future growth. His approach offers a blueprint for responsible investing in turbulent times. By the end of this chapter, it is evident that Buffett's interventions during the financial crisis were not only financially astute, but also socially responsible. He stabilized key companies, restored investor confidence, and reinforced the principles of long-term value investing. Next, we will explore Buffett and the idea of giving back, revealing how philanthropy and social responsibility have become integral to his legacy. Chapter 19: Buffett and the idea of giving back. Warren Buffett's philosophy extends beyond investing and business success. He firmly believes in giving back to society and using wealth to make a meaningful impact. For Buffett, philanthropy is not an optional activity. It is a responsibility. He often says that those who have benefited greatly from society have a duty to contribute to the greater good. Buffett's approach to giving is disciplined and thoughtful, much like his investing strategy. He does not give haphazardly or for public attention. Instead, he selects causes that have a lasting impact, focusing on education, health, and social welfare. He seeks to support initiatives that create sustainable value rather than temporary solutions. One of his most significant contributions is the creation of the Giving Pledge, together with Bill and Melinda Gates. The Giving Pledge encourages billionaires to commit the majority of their wealth to philanthropic causes during their lifetimes or after their deaths. Buffett's leadership and example have inspired hundreds of the world's wealthiest individuals to consider the broader social responsibilities of wealth. Buffett also practices humility in giving. He does not seek recognition or personal gain from philanthropy. His focus is on creating real, measurable change and empowering organizations to achieve their goals. This approach reflects the same ethical framework he applies to business and investing: transparency, integrity, and long-term thinking. Buffett believes in the power of education as a tool for transformation. He has donated billions to educational institutions, scholarships, and initiatives that improve access and quality. He sees education as a way to provide opportunities, empower individuals, and create a stronger, more informed society. This mirrors his broader belief in thoughtful investment: support what grows value over time. Another important aspect of Buffett's giving philosophy is consistency. He gives systematically, with careful planning and evaluation, rather than sporadically or impulsively. This approach ensures that resources are used efficiently and have a lasting impact. Buffett treats philanthropy as a long-term investment in society. Buffett also emphasizes collaboration. Through partnerships, foundations, and the Giving Pledge, he encourages other wealthy individuals to pool resources and work together. Collective action magnifies the impact of philanthropy and addresses large-scale social challenges more effectively than isolated efforts. By the end of this chapter, it is clear that Buffett's approach to giving is an extension of his life philosophy. Ethics, long-term thinking, discipline, and social responsibility guide both his investing and his philanthropy. He demonstrates that true success is measured not only by wealth accumulation, but also by the positive legacy one leaves behind. Next, we will explore the Giving Pledge and Philanthropy, detailing how Buffett's initiatives have influenced global philanthropy and shaped modern approaches to wealth distribution. Chapter 20. The Giving Pledge and Philanthropy. Warren Buffett's commitment to philanthropy took a historic form with the creation of the Giving Pledge. Together with Bill and Melinda Gates, Buffett launched this initiative to encourage the world's wealthiest individuals to commit the majority of their wealth to charitable causes. The Giving Pledge is not a legal obligation. It is a moral commitment to use resources for social good. Its purpose is to inspire billionaires to think beyond personal gain and contribute meaningfully to society. Buffett himself pledged to give away the vast majority of his fortune, mostly to the Bill and Melinda Gates Foundation. He structured this giving to ensure long-term impact, emphasizing careful planning, accountability, and measurable results. For Buffett, philanthropy is strategic. Like investing, it requires research, analysis, and patience to maximize benefits. The Giving Pledge also reflects Buffett's belief in collective action. He encourages others to join, creating a network of philanthropists who share knowledge, strategies, and insights. This collaborative approach amplifies the effect of giving, addressing global challenges like education, healthcare, and poverty. Buffett's leadership has inspired hundreds of billionaires worldwide to consider the social responsibilities of wealth. Buffett's philanthropic philosophy emphasizes sustainability. He focuses on initiatives that create lasting change rather than temporary solutions. This approach mirrors his investing principles. Identify opportunities with durable advantages, strong management, and long-term value. Philanthropy, for Buffett, is a long-term investment in human potential and societal stability. Another hallmark of Buffett's giving is transparency. He publicly shares his commitments, encouraging accountability and inspiring trust. This openness motivates others to act responsibly and demonstrates that wealth can be a force for positive change. Buffett's example shows that ethical leadership in philanthropy can influence not just individual lives, but entire communities. Buffett also emphasizes education as a transformative tool. Much of his giving supports scholarships, educational institutions, and programs that expand access to learning. He sees education as a foundational investment in society's future, much like investing in high-quality companies ensures long-term returns. Through this lens, philanthropy is an extension of his belief in creating enduring value. The Giving Pledge is more than a financial commitment. It is a cultural movement. It challenges the world's wealthiest to consider legacy, ethics, and responsibility. Buffett's leadership demonstrates that wealth carries obligations, and true success involves using resources to improve the world. His structured, ethical, and strategic approach sets a standard for modern philanthropy. By the end of this chapter, it is evident that Buffett's philanthropic philosophy is inseparable from his life principles. Ethics, long-term thinking, discipline, and social responsibility guide both his investing and giving. Next, we will explore Buffett and his personal life, revealing how his values, relationships, and character shaped his approach to business, philanthropy, and life. Chapter 21. Buffett and his personal life. Warren Buffett's personal life reflects the same values and principles that define his investing and philanthropy. He is known for humility, frugality, and a deep sense of responsibility. Despite being one of the wealthiest people in the world, Buffett maintains a modest lifestyle and emphasizes ethical living. Buffett grew up in Omaha, Nebraska, in a family that valued hard work, education, and financial responsibility. From a young age, he demonstrated curiosity, discipline, and an aptitude for numbers and business. These traits shaped not only his investing acumen, but also his personal character. He values learning, thoughtful decision-making, and long-term thinking in all aspects of life. Family and relationships play a central role in Buffett's life. He maintains close ties with his children and grandchildren, ensuring they are grounded, educated, and ethically aware. Buffett believes in passing values rather than just wealth. He encourages his family to understand money, responsibility, and the impact of their choices on society. Buffett's personal habits are reflective of his discipline. He lives in the same Omaha home he purchased decades ago, drives modest cars, and avoids excessive luxury. These habits demonstrate that wealth does not define happiness or character. Instead, thoughtful management of resources, ethical behavior, and focus on purpose matter more than ostentation. Buffett also values friendships and mentorships. His long-standing relationship with Charlie Munger exemplifies mutual respect, complementary thinking, and shared principles. Buffett cultivates connections that enrich knowledge, provide perspective, and foster growth. He chooses associates who share his ethics, discipline, and long-term vision. Health and well-being are another focus. Buffett follows routines that maintain physical and mental vitality, understanding that longevity and clarity are essential for effective decision-making. He balances work with personal interests, including reading, bridge, and community engagement. These pursuits contribute to a holistic and grounded life. Buffett's personal philosophy extends to how he handles public attention and fame. He prefers privacy, avoids extravagance, and communicates with simplicity and honesty. This approach aligns with his belief in transparency, rationality, and integrity. It allows him to focus on meaningful work rather than distractions of status or image. Finally, Buffett integrates personal ethics into all aspects of life. He believes in honesty, responsibility, and fairness in relationships, business, and society. His character provides a foundation for decision-making that is consistent, rational, and socially conscious. For Buffett, personal life, investing, and philanthropy are interconnected, guided by principles that endure across time and circumstance. By the end of this chapter, it is evident that Buffett's personal life is a reflection of his core values: humility, discipline, integrity, and responsibility. Next, we will explore Buffett and the idea of succession, examining how he plans for the future of Berkshire Hathaway and ensures continuity of his philosophy beyond his tenure. Chapter 22: Buffett and the idea of succession. Warren Buffett has always been deliberate about the future of Berkshire Hathaway. He recognizes that a company's longevity depends not only on current leadership, but also on thoughtful succession planning. Succession is not just about replacing a CEO. It is about preserving the culture, values, and principles that define the organization. Buffett's approach to succession is methodical. He identifies leaders who embody integrity, long-term thinking, and disciplined decision-making. These individuals must understand the company's philosophy and possess the ability to make rational, ethical decisions under pressure. Choosing the right successor is critical because the wrong leadership could erode value and disrupt the company's culture. Buffett emphasizes continuity over novelty. Berkshire Hathaway's success is built on principles of decentralized management, strong corporate governance, and disciplined investing. He looks for successors who respect these principles rather than imposing their own style for short-term recognition. This approach ensures that the company's foundation remains strong, even as leadership changes. Mentorship is a central part of Buffett's succession strategy. He invests time in mentoring potential successors, sharing insights, experiences, and judgment honed over decades. Buffett believes that leadership is not just about intelligence or technical skills. It is about character, judgment, and ethical responsibility. By cultivating leaders in this way, he ensures that the company's values are preserved. Buffett also emphasizes transparency and communication. He wants stakeholders to understand that succession planning is ongoing, deliberate, and thoughtful. This reduces uncertainty, maintains confidence among investors, employees, and partners, and reinforces the stability of Berkshire Hathaway. Another important element is risk management. Buffett prepares for both expected and unexpected transitions. He ensures that the company can thrive under new leadership without compromising performance or culture. This foresight demonstrates his long-term perspective. Succession is not an end, but part of continuous stewardship. Buffett's succession planning also reflects humility. He acknowledges that no one is irreplaceable, and the company's success must endure beyond any individual. This mindset allows him to make rational decisions rather than allowing ego or attachment to influence outcomes. It is consistent with his broader philosophy of rationality, ethics, and long-term thinking. Finally, succession planning highlights Buffett's understanding of legacy. He wants Berkshire Hathaway to remain a model of disciplined investing, ethical governance, and value creation for decades to come. The goal is not just to maintain financial success, but to preserve the principles and culture that have defined the company. By the end of this chapter, it is evident that Buffett approaches succession with the same care, discipline, and foresight that characterize his investing philosophy. Next, we will explore Buffett on what makes a good manager, examining the traits, behaviors, and principles he values in leadership, which are critical for sustaining long-term success. Chapter 23. Buffett on what makes a good manager. Warren Buffett places great importance on management when evaluating investments. He believes that strong, ethical, and capable managers are critical to the long-term success of any company. Buffett's philosophy emphasizes character, competence, and alignment with shareholder interests over flashy strategies or short-term performance. A good manager, according to Buffett, is trustworthy. Integrity is the foundation of leadership. Managers must be honest, transparent, and committed to ethical practices. Buffett avoids companies with executives who engage in deception, manipulation, or self-serving behavior, understanding that dishonesty can destroy value over time. Competence is another key trait. Managers must understand their industry, operations, and the factors that drive business performance. Buffett values leaders who can make rational decisions under pressure, balance risk and opportunity, and allocate capital wisely. Technical skill alone is not enough. Judgment and strategic thinking are equally important. Buffett also emphasizes rationality and patience. Good managers do not react impulsively to market trends, hype, or short-term fluctuations. They prioritize long-term value creation over immediate gains. This quality aligns with Buffett's own investing principles, ensuring that management and shareholder interests are closely aligned. Another trait Buffett values is a clear vision paired with disciplined execution. Managers must set realistic goals and pursue them methodically. They should focus on strengthening the business, improving efficiency, and building sustainable competitive advantages. Overambition or reckless expansion can lead to poor outcomes, even for talented leaders. Buffett places a strong emphasis on communication. Managers must communicate clearly with shareholders, employees, and stakeholders. Transparency builds trust and reduces uncertainty, particularly during challenging times. He admires leaders who can convey complex information in a straightforward and honest manner. Long-term orientation is essential. Buffett prefers managers who think in decades rather than quarters. They should prioritize investments, policies, and strategies that produce sustainable growth rather than chasing short-term accolades. This approach creates enduring value and stability for shareholders and employees alike. Delegation and empowerment are also important. Buffett values managers who can build strong teams, trust competent employees, and foster a culture of responsibility and accountability. Micromanagement and over-control are signs of weak leadership. Strong managers empower others to contribute meaningfully to the company's success. Finally, Buffett appreciates humility and self-awareness. Effective managers recognize their limitations, seek advice when needed, and are willing to admit mistakes. This openness fosters learning, adaptability, and resilience, traits essential for long-term success. By the end of this chapter, it is clear that Buffett evaluates managers through the lens of ethics, competence, rationality, and long-term thinking. Next, we will explore Buffett and the future of Berkshire Hathaway, examining how he envisions the company continuing its legacy, sustaining growth, and maintaining its principles beyond his tenure. Chapter 24: Buffett and the future of Berkshire Hathaway. Warren Buffett has always been focused not just on the present, but also on the long-term future of Berkshire Hathaway. He understands that the company's longevity depends on maintaining its culture, values, and disciplined investment philosophy beyond his own tenure. The future of Berkshire Hathaway is tied to succession planning, strong management, and adherence to principles that have guided its success for decades. Buffett envisions a company that continues to operate with decentralized management. He believes in empowering capable managers to make decisions independently while adhering to the company's ethical and financial standards. This decentralized approach fosters responsibility, accountability, and operational excellence. It also ensures that the company remains agile, even as leadership transitions occur. Long-term value creation is central to Buffett's vision. Berkshire Hathaway's strategy is not to chase short-term trends or speculative opportunities. Instead, it focuses on acquiring and nurturing businesses with strong fundamentals, predictable earnings, and durable competitive advantages. Buffett's successors are expected to continue this disciplined approach, preserving the company's core philosophy. Buffett also emphasizes the importance of culture in sustaining the company's future. Berkshire Hathaway's culture is built on trust, transparency, integrity, and rational decision-making. These values are reinforced in management selection, investment decisions, and interactions with employees, shareholders, and partners. A strong culture ensures consistency, resilience, and alignment with long-term goals. Succession planning remains a critical aspect of Buffett's vision. He has carefully identified and mentored potential leaders who embody the company's principles. Buffett believes that leadership is about character, judgment, and ethical responsibility, not just technical skill or ambition. By preparing successors thoroughly, he ensures that Berkshire Hathaway can thrive for generations. Buffett's future outlook also includes financial prudence. He expects the company to maintain substantial cash reserves, enabling it to act decisively during market opportunities or crises. Liquidity and disciplined capital allocation are cornerstones of the company's stability and growth. These practices protect the company from unnecessary risk while allowing it to seize value-creating opportunities. Innovation and adaptability are encouraged within the framework of core principles. Berkshire Hathaway is not stagnant. It evolves by acquiring new businesses, improving operations, and responding to changing market conditions. Buffett balances adaptability with discipline, ensuring that innovation does not compromise the company's long-term integrity or risk profile. Buffett also considers the company's broader responsibility to society. Ethical investing, transparency, and thoughtful philanthropy are part of the company's legacy. Berkshire Hathaway is not just a financial enterprise. It is a model of disciplined, responsible, and value-driven business. The company's future depends on continuing this legacy of ethical leadership and long-term thinking. By the end of this chapter, it is clear that Buffett's vision for the future of Berkshire Hathaway is comprehensive and strategic. It encompasses leadership, culture, financial prudence, ethical responsibility, and long-term value creation. Next, we will explore closing thoughts on Buffett's legacy, summarizing the lessons, principles, and enduring impact of his life and work. Chapter 25. Closing thoughts on Buffett's legacy. Warren Buffett's life and career provide a blueprint for disciplined investing, ethical leadership, and meaningful philanthropy. His legacy extends far beyond the financial returns of Berkshire Hathaway. It encompasses the principles, values, and character that have guided his decisions and inspired generations of investors. Buffett's investing philosophy is rooted in long-term thinking, patience, and rational analysis. He avoids speculation, focusing instead on businesses with strong fundamentals, durable competitive advantages, and capable management. His approach demonstrates that wealth is created through discipline, knowledge, and ethical decision-making rather than hype or shortcuts. Ethics and integrity are at the core of Buffett's legacy. He consistently prioritizes honesty, transparency, and fairness in business and investing. This ethical foundation has earned him the trust of shareholders, managers, and the broader public. Buffett's example shows that character is as important as skill in achieving lasting success. Buffett's role as a teacher and mentor has extended his impact. Through letters, interviews, and public appearances, he shares wisdom, insights, and lessons from decades of experience. He emphasizes practical, timeless principles rather than trends or gimmicks. By educating others, Buffett multiplies the influence of his philosophy and inspires responsible investing worldwide. Philanthropy is another cornerstone of Buffett's legacy. His commitment to giving back, exemplified through the Giving Pledge, demonstrates that wealth carries responsibility. Buffett has shown that strategic, thoughtful philanthropy can create lasting societal value. His example encourages others to consider the broader impact of their wealth, actions, and decisions. Buffett's personal life reinforces his principles. He lives modestly, values family and relationships, and practices humility. His habits reflect consistency, discipline, and thoughtful decision-making. By aligning his personal life with his professional philosophy, Buffett demonstrates authenticity, integrity, and coherence. Buffett's approach to leadership and management is equally enduring. He values ethical, competent, patient, and transparent managers who prioritize long-term value. His emphasis on succession planning ensures that Berkshire Hathaway can continue thriving beyond his tenure. This foresight highlights the importance of sustainable leadership and preserving corporate culture. Buffett's legacy also teaches resilience and rationality in times of crisis. From the dot-com bubble to the financial crisis of 2008, he remained calm, disciplined, and opportunistic. He demonstrated that rational thinking, patience, and adherence to principles protect both wealth and reputation during turbulent times. Finally, Buffett's life demonstrates that true success is measured not only by wealth but by impact. His influence spans investing, education, philanthropy, leadership, and ethics. Buffett's legacy is a model for creating enduring value in business and society. He shows that combining intelligence, discipline, ethical responsibility, and long-term thinking can produce results that last generations. By the end of this final chapter, it is clear that Warren Buffett's life offers lessons far beyond finance. His legacy is a testament to disciplined investing, ethical leadership, and purposeful giving. It inspires investors, business leaders, and individuals to pursue excellence with integrity, patience, and vision. Thank you for listening to this full summary of Tap Dancing to Work by Carol J. Loomis. If you enjoyed learning about Warren Buffett's life, investing wisdom, and timeless principles, make sure to subscribe to our channel. By subscribing, you will get access to more summaries, insights, and stories that inspire smarter decisions and a richer understanding of the world of finance and beyond.